profit that you receive is in the form of cash. This is now your passive income.
My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach. I'm a TEDx speaker and also a financial influencer, working on that one single mission to help entrepreneurs and professionals to be not dependent on that one single source of income so that they can have abundance of money in their life just by managing the money they already have.
How can I make passive income from equity investments? Because equity is all about growth. How can you make passive income out of this? But that's also possible. How do we do that is what I'm going to share with you now. So there are three simple ways of doing this. The first way is dividend via stocks. So when you invest into a stock, it pays you dividend until today. So not rather until today, until the decision that was made by the finance ministry that dividend income will be tax-free. This was a great option because you could buy companies like Indian Oil Corporation who pays almost 10% dividend. So you can make 10% fixed returns on a stock which is a PSU owned, and hopefully the price, even if the price of the stock remains where it is, you made 10% fixed income. Price of the stock goes up, great, you made more money. Price of the stock goes down, at least 10% का cover तो है आपके पास. Now the problem is this 10% of whatever dividend income you will receive is fully taxable as per your tax slab. So this is not lucrative anymore as it was in the past. Another thing about that is when you receive, if you buy a stock for 100 rupees and they pay 10% dividend, if the price of the stock goes to 110 and the dividend is paid of 10 rupees, the price of the stock will come back to 100. So the only income that you made will be in the form of dividend, and dividend will be fully taxed. On the contrary, if the company was not paying you any dividend and you sell the stock after 1 year, then up to 1 lakh rupees, you don't have to pay any tax on that as per long-term capital gains in equity. So if it was better for you if the company was not paying any dividend and you book the dividend as a profit for yourself, or you book the capital gain as a profit for yourself, this way you don't have to pay any taxes on this. So dividends have become inefficient, which was the most efficient thing in the stock markets, is now the absolute opposite of this. आपने 100 rupees का stock लिया, 100 rupees का stock becomes 110, ठीक है? अब now we have two cases. One case, the company pays dividend, which means 10 rupees paid in dividend, the price of the stock will come back to 100 rupees the next day because 10 rupees is paid out from the reserves of the company. Dividend कहाँ से आता है? Profit से ही तो आता है company के, reserve से आता है. तो अगर उसने आपको वो reserve दे दिया तो उसकी enterprise value कम हो गई, उसके reserves कम हो गए, तो stock price भी नीचे आ जाएगा. With the same amount, say 10 rupees per dividend is paid out, so 10 rupees will be reduced from the price of the stock. This dividend that you receive, you have to pay tax as per your tax slab. In the past, this was tax-free. It was great for you. You don't have to do anything. Company will keep on paying you dividend and it's tax-free. Amazing. Now, company pays you dividend, you have to pay full tax as per your tax slab. On the contrary, as of today, if a company, you invest in 100 rupees, the company becomes 110, and now you manually sell 10 rupees worth of share after 1 year, which means what? That long-term capital gains in equity after 1 year are taxed at 10%. But this 10% starts after the first 1 lakh of capital gains that you have made, or that first 1 lakh is absolutely tax-free. Now think. In the second scenario, you're making tax-free income at least for up to 1 lakh. In the first scenario, you're paying tax as per your tax slab. So now dividend via stock is an inefficient way of creating passive income from equity. Ideally, you should look at capital gains and trying to book it yourself. Even if you don't wait for 1 year and you come in short-term capital gains, that is also 15%. And most of you are likely in 20 or 30% more tax. So आपका tax वैसे भी कम है. If you wait for more than 1 year, even then you pay maximum 10% tax, even then you're better off. So dividend via stocks is now, you can call it a dead way of making passive income because it's fully taxable. Unless you are investing from that account जिसमें कोई tax लगता नहीं है, which is in the 0% tax slab, only then you are on the same page. So this is another thing we have to take into the strategy of investing, especially from the file from which we're going to invest into stocks. Although this is not something we're discussing at much length because this is not the time to invest in stocks, as per us at least. So this will come into the strategy in play when the market's correct, and then we would ask you to start investing in stocks. When that happens, that's when the decision of कौन से file से invest करना है will be a major play. The other method which most of the other people use, this is mostly used through mutual funds, is known as systematic transfer plan. So systematic transfer plan क्या होता है? That you invest through in a mutual fund and then systematically the money, systematic withdrawal भी कहते हैं, SWP. It's known as SWP as well, where you systematically withdraw the money from your equity investments back into your account. So let's say systematic withdrawal plan will say कि 2 years before the maturity or 2 years before certain time, you'll start slowly receiving all the money back. Now, this is also great, but इसका सबसे बड़ा flaw क्या है? It is that your withdrawal should be on the basis of valuation, not on the basis of time or automation. What does that mean? When I say withdrawal should be on the basis of valuation, means you cash out from something which you feel now is more than its worth. You sell something which you believe that now the price should not likely rise. So when you are investing in stocks, and as per the strategy that we follow, we buy companies which are at discounted prices. And then we sell them when they come to their fair value. उसके बाद वो ऊपर जाए नीचे जाए, we don't even look at it. Here the decision is made on the basis of valuation. And profit that you receive is in the form of cash. This is now your passive income. Because you bought a stock at 100, you sold it at 125. 25 rupees gain is now sitting in your bank. If you reinvest this 100 rupees, great. If you don't, then 125 is sitting in your account. So you're able to realize the profit as passive income for yourself. And you can withdraw this 25 as well, if you would like. This is the third method that we follow, the profit only strategy, that you invest, only keep on withdrawing your profits if you don't want to use compounding. If you want to use compounding, obviously you'll reinvest that money. But if passive income chahiye from equity, then you withdraw your profits consistently from the equity markets. This mostly will be in the format of the stock investment portfolios. So the whole idea here is that if you go for systematic withdrawal, you're withdrawing your capital as well. So अगर आपका portfolio ने return नहीं दिया तो वो आपका capital withdraw करके आपको देना शुरू कर देगा, which is potentially booking a loss and withdrawing your money. Even if you made a profit, even then you're not sure if this is the best time to exit or not. So systematic withdrawal plan does not take into account the valuation. It only takes into account the time and the system of doing it, which is system is good, but without valuation is just a system which works without any surety of gains. So the third method is the preferential method, where you invest into a stock strategy. You book your profits consistently every now and then, and you're able to withdraw the profits, let's say on a quarter or yearly basis. So you know for sure, मैंने 10 लाख लगाए, 10 के 12 लाख हुए, 2 लाख रुपए मैंने निकाले. This is my passive income this year. So on and so forth. At least 1 lakh rupees passive income per file you can create without paying any taxes to the government. Why not use that? So this is exactly how the approach should be of creating passive income from your equity investments.